Hi, I'm Rex Whitford, a specialist SMSF advisor. I've been helping trustees of self-managed super funds, SMSFs, unlock the full potential of their funds for over 10 years. Welcome to our series of presentations on the many aspects of running an SMSF. In today's webcast, I'll be introducing you to self-managed super funds, the fastest growing sector of Australian superannuation. Please note that these presentations are of a general nature and should not be used as a substitute for personal advice from a suitably qualified professional. Note the date on this presentation is July 2014 and laws pertaining to self-managed superannuation change frequently. During this presentation, I'll be answering your questions on why are SMSFs so popular? What is an SMSF? What is involved in running an SMSF? As I mentioned, SMSFs are now the fastest growing sector in the $1.4 trillion superannuation industry. Since 2008, there have been around 26,000 new funds starting each year at an average size of approximately $500,000. To give a balanced perspective though, it is important to point out that while SMSFs are very popular, a great many also close once clients discover that they are not as easy as they may have first thought. It would be incorrect to assume that at Wealth for Life Financial Planning we advocate SMSFs for everyone. We certainly do not. In fact, we either fix or close as many funds as we might recommend to be started. So why are SMSFs so popular? Well, first of all, investment choice. The huge range of investment choice compared to other retail and industry super funds, including listed shares, unlisted shares, direct property or residential property, collectibles, gold bullion and more, so long as the investment is allowed within the superannuation law and the written investment strategy of the fund. Control. This is often the most common reason, though this is a perception in many cases on the part of the client. There are many things that can be done with an SMSF that allow more flexibility than a retail fund. For example, transferring assets in specie into the fund, such as a business real property, the ability to pool members' account balances to allow the purchase of an asset not otherwise affordable, the ability to control costs, which may, in many cases, be less expensive than retail fees. Though this is normally not the case with accounts less than $250,000, which is what we would consider the minimum account balance to start an SMSF. It is important to point out here that if cost is the reason why you base the decision to open your SMSF on, then you may be disappointed. Running an SMSF may be time consuming, and if you choose to outsource some of the work, such as the fund administration, then there will be a cost involved there. You must also consider the cost of making poor investment decisions. As an SMSF trustee, you own all the decisions, good and bad. Superannuation receives concessions provided by the government of $32 billion per year, the largest concession provided to any sector of the economy. So they're very keen to ensure that trustees abide by the strict rules to protect their retirement savings. So what is an SMSF? An SMSF is a super fund with 4 members or less. All members are trustees or directors of a corporate trustee. Members cannot be an employee of another member unless related. Trustees cannot be paid for their duties or services as a trustee. Being a trustee means that you need to act in accordance with the rules of the fund, the trust deed. Superannuation Act 1993 and the 1994 regulations, the Income Tax Assessment Act, the Tax Admin Act 1953 and the Corporations Act. While you don't have to have an intimate knowledge of the legislation, having an accredited specialist advisor who does will help. Let's look at the trust deed. The trust deed sets out who the trustees are, how the trustees are appointed and removed. A very important point is how to remove a trustee if needed. The powers of the trustee and their voting rights, who can be members, the contributions that the fund, for example, in specie contributions, can make, the rules relating to payment of benefits to members and beneficiaries. All members need to be a director of a corporate trustee, and all directors need to be members. Trustees can either be individuals or directors of a corporate trustee. Most funds are set up as individual trustees, normally to save money. The corporate trustee structure is generally superior. It allows for easier transition of trustee replacement, such as on death of a trustee. And if the fund holds many assets, such as shares in the fund, all the assets need to be updated with the new trustee. However, if a corporate trustee is used, then only the director needs to be updated. For a single member fund, if using a corporate structure, then they may be the sole director of that corporate trustee. If it is a single member fund with an individual trustee structure, there must be two trustees, but one of which may be a non-member. All SMSF assets need to be listed in the name or names of the trustee. Changing the ownership details for individual trustees can be costly and time-consuming if your fund owns many assets. A corporate trustee provides limited liability to the corporate trustee if sued, rather than the assets of the individual trustees. For example, if a fund holds a residential property as an asset and the tenant were to injure themselves slipping on, say, the driveway, and then decided to sue the trustees, then any liability will be limited to the corporate trustee with a corporate trustee structure and not the assets of the members, as would be the case with an individual trustee structure. If borrowing inside the SMSF, most banks are going to require a corporate trustee. The ATO requires a declaration by new trustees called the Trustee Declaration Form. It states that the trustees must understand their obligations and duties, and it must be available for inspection by regulators or approved auditor. A $1,700 penalty for failure to declare or maintain records. Declaration removes ignorance as a defence for a breach of the law and allows the ATO to apply harsher penalties for non-compliance. So trustees are required to keep themselves informed of changes to legislation. You are the trustee, after all, and you are responsible for these things. We are now going to talk about some of the other very important rules. The purpose of setting up your SMSF is to provide for your retirement. SMSF assets cannot be used for personal benefit under any circumstances. Breaking the rules can mean that your SMSF losing its complying status and thus its tax concessions. Penalties can be levied at the highest marginal tax rate for non-complying funds. From the 1st of July 2014, penalties have been softened for more minor breaches, and the ATO given more discretion on how these are applied. However, the ATO may elect to apply the existing regime of harsher penalties for more serious breaches. Penalties of up to $220,000 may be levied to be paid personally. Now, what this means is you can't use the money inside the fund to pay this personal penalty. Other members of the fund may take legal action against you if you have not acted in accordance with the trust deed. Some or all of the penalties may apply, and once again, ignorance of the law is not a defence. One of the key areas of responsibility is to manage the fund's investments. There are duties and responsibilities when making investment decisions designed to increase the value of the member benefit for retirement. One of the most important rules when it comes to running your SMSF is the sole purpose test. The SMSF needs to meet the sole purpose test, which means the fund needs to be maintained for the sole purpose of providing retirement benefits for members or their dependents or their legal personal representative if the member dies before retirement. As a trustee, you need to maintain the SMSF so that it complies with the sole purpose test at all times while the fund exists, including when investing assets and paying benefits to members upon retirement. The fund needs to comply so that it remains eligible for the concessions available to complying super funds. If you're unsure about an investment of the SMSF satisfying this sole purpose test, then look at the character and purpose of the investment. If you or any party obtain a financial benefit from the investment other than increasing the value of the fund, then it's likely the fund will not meet the sole purpose test. When investing in such items as collectibles, art or wines, it's important that members are not granted use or access to the investments in contravention of the sole purpose test. Most common breaches are investments that provide a pre-retirement benefit to the member or related party to the financial detriment of the fund. Look at the pictures here. Okay? Would any of these provide a benefit to a member other than in accordance with the sole purpose test? As an example of investment risk, the global financial crisis in 2008 had a huge impact on everyone's assets held in superannuation. The real pain is being felt by those retirees who were relying on their superannuation to provide a regular paycheck. One of the major risks faced by SMS investors is how they invest their money. That is, what is your asset allocation? Now, the asset allocation relates to the percentage of assets held in different asset classes such as cash, fixed interest, shares, property, collectibles and others. Now, trustees need to be aware of scams. A recent report from the Australian Crime Commission showed that over the past 5 years, over $113 million had been scammed from SMSF trustees. The report showed that the scams are becoming more sophisticated and are directly targeted at the massive pool of funds held in self-managed superannuation. The report showed that the majority of victims were well educated, financially literate, over the age of 50, males who had invested before. Now, what this shows is that the sophistication of these schemes is such that even experienced investors are being caught out. SMSF trustees do not have access to the Superannuation Complaints Tribunal through the Australian Prudential Regulatory Authority, APRA, that other retail super funds do. Signing that trust deed means that trustees understand the risks. So it's important that they do in fact understand all the risks involved with being a trustee before parting with their hard-earned cash. Falling victim to scams, poor investment decisions such as chasing returns based on past year's performance also impact on the ultimate outcome of the fund's return. In another webcast, I'm going to discuss in more detail how to effectively invest your fund's money, the psychology behind investing and how to remove the emotional element that can affect the decisions of trustees when investing. As I said earlier, managing the investments of your SMSF is an extremely important aspect of having an SMSF, and so it's no surprise that there are certain rules and standards that must be adhered to. One of these is to prepare an investment strategy for the fund and regularly review it. The investment strategy must be written and given effect to. Your investment strategy provides you and the other trustees a framework for making investment decisions. The strategy needs to consider the purpose and circumstances of your fund, risk and return, diversification, liquidity and cash flow requirements, the ability to pay liabilities, and insurance premiums. 90% of all investment returns will come from the asset allocation of the fund. I say investment return because there is another very important return to be attained, and that is what I call the legislative return. This is the return that you get when you structure your fund's affairs to optimise the outcome under the prevailing legislation, and it is a very powerful return indeed. This is where a specialist advisor will add real value. We commonly see an asset allocation inside investment strategies with a range of 0 to 100% across all the assets. Trustees think that this gives them total flexibility, but such an undisciplined asset allocation actually detracts from the predictability of the ultimate investment outcome. The investment strategy and the asset allocation needs to be crafted to meet the specific needs of the fund. It needs to set out the fund objectives and set out the methods the trustees intend to adopt to meet these objectives. Diversification reduces your risk of poor investment decisions, undermining your entire strategy. The government wants you to be self-sufficient in retirement. So having a well-crafted investment strategy will help achieve this and allow your fund to be compliant. Super laws also place restrictions on the entities that your super fund can invest in or with, and the entities that your fund can acquire assets from. You need to ensure that the fund's ownership of its investments is secure. The fund's assets should be held in a legally recognised ownership arrangement in either the names of all the individual trustees as trustee of your fund, or the name of the company as trustee for the fund in the case of a corporate trustee. You can't lend money or provide direct or indirect financial help from the fund to a member or a member's relative. What this means is that you can't use the money of the fund to pay for the children's school fees. Now, you may only borrow in very limited circumstances. There has been a huge interest in SMSF, in part due to the ability to acquire property through what's called a limited recourse arrangement. Now, these arrangements are very complex, and if not structured properly from the outset, some arrangements are simply not able to be restructured, forcing the sale of a property at a substantial loss. Now, given the complexities surrounding this one aspect, we've dedicated a separate presentation on this topic. Whether putting a property in your fund is a good or bad idea depends greatly on the circumstances. While there are many advocating this as a strategy, it should come with a very strongly worded wealth warning. If you would like to know what our opinion is on this, then please contact us for a consultation. As a general rule, you can't acquire an asset from a member or a related party of the fund. There are limited exceptions to this rule where the asset is a listed security, for example, a share or managed funds, and the asset is acquired at market value, or the asset is business, real property and acquired at market value. With the amount of concessions being paid to complying superannuation, it's fair to say that the amount of regulation and legislative change is only likely to increase. With changing economic times, investments and scams out there, you need to be prepared to stay on top of your responsibilities as a trustee. Ask yourself, do you have the time, the knowledge and skill required to run an SMSF? Can you do it all yourself, or would you like some guidance and mentoring? Do you wish to outsource some of the management aspects of the fund, or would you prefer to do it all yourself? Other things to consider are, do you have sufficient assets to make the fund viable? If you start a pension, how long are you likely to continue to have sufficient funds to justify the cost? Do you want to be running an SMSF in retirement? Do you understand what is involved in managing your own fund? Remember to make sure the fund is to provide retirement benefits. Before you make the leap, compare the cost of alternatives. I've tried to present a balanced introductory view of SMSFs to assist you in making what is an important decision, but just remember that this presentation has only been a brief introduction. Our other presentations may be of assistance. Just remember that these presentations are also only an overview. There is much more detail, and don't fall into the trap of thinking that if you watch all the video presentations, then you'll know all there is to know. As I often say, you don't know what you don't know. Remember, good advice and education puts you in control of your financial future. As an SMSF specialist advisor, I can provide you with the information and support that you need while you control and direct your self-managed superannuation fund. I would encourage you to view our other educational videos available on our website. If you feel that we may be able to help you, then please contact us for a consultation. We'd be more than pleased to meet with you in person at our office. We also assist Australians all around the country and overseas. Thanks to Skype and our use of technology, no one's too far away to assist, and we look forward to assisting you achieve your financial goals. Thanks for listening and enjoy the rest of the presentations.